Very good morning, friends. To each one of you, it's a pleasure to see you. Connecting on this platform on a Saturday morning, and I promise that I will add maximum value to your time. We'll keep it very short, very crisp, and to the point, and something which will help you immediately going into Monday and applying some of these strategies which can improve the outcome of your trading strategy. Now, let us take an example of intelligence quotient. So IQ is something which measures the intelligence of an individual, and back in the days when Albert Einstein, the IQ test was done for this gentleman, he had an IQ of 160. I think the total is around from 165. He had like an 160 IQ. Consider, a layman talking to Albert Einstein. Anything that he said would sound alien, and people would just not understand. So that was the gap between a common man and an Albert Einstein back in those days. But today, fast forward to 2023, we have computers, the best of AIs, which have an AI of around 155, and this is increasing at a very, very fast pace. Now, 3 years down the line, this AI is expected to have an IQ of 1600. Now just imagine talking to a computer with an IQ of 1600. Everything would look alien, everything would be something which we will not understand or apprehend. So the trick is, or the point that I'm trying to make is, the competition is only going to become more intense, and this is not happening in the next 5 years or 10 years. This is actually happening as we speak, and it is progressing at a very, very fast pace. We've already seen the kind of impact that the markets have had after algorithms came into play. At least the thing about algorithms was the rules were hard-coded, the entry and exit points were predefined, and it just kept on doing its thing. The thing with AI is it will sort of change the game and put you, in fact, make decisions so fast, and it will be based on massive amounts of data. So in such a scenario, how do we improve our game? How does a common trader or an investor improve his overall experience and his profitability in the market? So one thing is a common denominator for every participant in the market. One that is the data that everybody is seeing. The data, the news flow. So more or less everybody has this access to the same information, the same data, and the same developments. So why is it that some people are doing very good in trading and some people are doing average, and some people are, or a maximum chunk is doing below average? SEBI released a report recently where they said 90% of the derivative traders, the retail traders, lose money in the market. Now the reason for that is obviously we all are good people. We all put our best of intentions and efforts when it comes to trading, but still everybody has different outcomes. The reason for this is what is happening between our 2 ears. So the way we are wired, the way our mindset is, that is what will decide, that is what will determine what the outcome of your trading strategy would be. Trading strategy can be as simple as trading on an hourly basis, following a very simple thing like Bollinger Bands, or even simpler, you are simply trading whenever there is a range breakout that happens during the day, or you are trading simply if the market crosses previous day's high, I will buy. If the market breaks previous day low, I will go short. So the strategy can be anything under the sun, but if you don't have this side of the equation, which is how are you going to make those decisions in the important deciding moment, is what will decide your trading outcome. So jumping immediately onto the crux or the core part of this. So the first thing that we have to begin with is identifying the edge. Now what is the edge? Edge basically means that you are slightly ahead of the curve or slightly better than the rest. Now let me give you an example. So if you toss a coin, the probability is 50-50. 50% probability it comes heads, 50% probability it comes tails. But let us say you have either, it could be our research, our advisory, or it could be your own research, own advisory, own analysis, and say, based on your experience, you say that I am right 60% of the time, or I'm right 65-70% of the time. So that becomes your edge. Now, when it comes to edge, it could be just one thing that you follow, or it could be a mix of 10 different things that you follow. So the first step towards this is identifying your edge. So most of the times what happens is people are not sure what edge do they have in the market. So how do we determine that? So one way to determine your edge and see how good it is to do back testing. So you can back test your whatever strategy that you've cherry picked for the last 12 months, 6 months, 18 months. Time frame can be different depending on the strategy is an intraday strategy or a monthly strategy or a weekly strategy, depending on how big your time frame of your original idea generation is. You can do a back test, and in that back test, if the strategy does work out to be anything above 55%, you've got an edge. So anything above 55, why did I say 55%? I could have said 51%, because yes, there are trading costs, there is cost associated, there is impact cost, so we have to take care of that as well. So if your edge is 55% better than the rest of the market, you can make money with that strategy. Now, if you have an edge which is as high as 90%, you don't need anything else. Just stick to your edge and follow the rules. Now, coming to rules, the problem with rules is everybody is rigid with their targets, but they are very flexible with the rules. To put it simply, what we do is we compromise with our rules as per the situation. So for example, at the beginning of the month, on one fine Saturday, you would have thought, okay, this is what my strategy is. I will always keep a stop loss. I will always exit at good at say 5% profits, 10% profits. But when it comes to actually trading in the market, we become flexible with these rules. So the first stepping point, or in terms of taking this game to the next level, is to be very, very, very rigid with your rules. Rules should not be compromised under no circumstance. And you have to be flexible, or you have to learn to be flexible with the outcome. So let us say I'll take a random name. So Mr. Aditya has a target that this month I will make 1 lakh rupees from the market. This is my internal target. Now what happens is, like in cricket, for example, because we just saw the cricketing event take place between India and Pakistan. Now we don't know whether the rain will happen or not. We don't know when the match begins, whether the ball will swing or not. Of course, we have an idea. If there is a green pitch, we'll need to have a more defensive approach. If it is a flat batting track, we can actually take risk and score more runs. But what if there is a new bowler in the opposition which we are not prepared for? So when we have a fixed target, say make 350 runs in 50 overs or make 300 runs in 50 overs, and if we don't go as per the target in between, we are bound to face disappointment. We are bound to make wrong decisions. So it is important to know the direction. The direction is basically we are making, we are in terms of markets, we can say I will be profitable for this month. But I don't know whether I'll make a lakh rupees or I'll make 50,000 rupees or I'll make 10 lakh rupees. Let the market decide that. Market does not know that Mr. Aditya or Mr. Ashish or anybody, for that matter, is a market participant. It does not give, a damn about who the market participants are. Markets are indifferent to indifferent to who is trading, when he is trading, or when he or she is making a mistake or doing the right thing. So markets don't give a damn about anything. Never take markets personally. So, a lot of people have that tendency that, markets took away all my gains. I was sitting on a 5 lakh profit, but the market just took away that gain in one session. And today I'm just making 50,000 rupees. So that is when revenge trading will come into play. That is when a lot of things go wrong. So to put it simply, the bottom line is a lot of people are fearful when they have to be hopeful, and a lot of people are hopeful when they have to be fearful. Simple example, 100 rupee stock goes to 105. You are sitting on a 5 rupee profit or a 5% gain. Now, instead of becoming hopeful that the stock will go to 110, which is a winning trade can become an even bigger winning trade. you will be fearful and say, oh yaar, what if the market takes away my gains? Let me book it off right away. Let me take money home, which is not wrong. Money in the bank is always better than money in the books. But what if that trade turns out to be a trade like NTPC, a trade like, some of the PSU banks, some of the PSEs have done in the recent past? What if, that trade turns out to be an REC or a PFC? You never know. So what happens is you may miss out on the big return generating trade that would have been the trade of the year by just booking in too early. So you are fearful when you have to be hopeful. And let us say this stock after buying at 100 goes to 95. Most of the times, most of the people will be hopeful. No yaar, tomorrow this may come back, this may bounce back, this may come back to 98, this may come back to 102. I will at least break even and I will book profits as and when the trade comes to break even or comes into my favor. So what happens is at this point in time, the stock goes from 95 to 90, the losses increase. And how many of you have had that experience that you are eating like birds but shitting like elephants? What it means is the profits are small but the losses are big. Now, one thing that we have to understand in the market is it is not about strike rate. It is not about whether you are right or wrong. What matters in the market is whether you are making money in the market or not. Okay, so identifying the edge. So once you've identified the edge, it is not about the strike rate alone. It is about the profitability. So what is profitability? Profitability is after you've done say 100 trades or 200 trades or whatever the number may be, are you making money at the end of it? You may be sort of having a strike rate which is as low as 25%, but if in those 25%, if you make those big moves, you will still be profitable. Now, it is not easy to do that having a 25% strike rate. So having at least a 55% strike rate and above would be ideal so that you can sleep peacefully at night. You can sort of, take, risk. You can be in a better shape of mind, to put it simply. Now, once the profitability in place, all you have to do is stick to that edge. Now, it is easier said than done, but when it comes to actually trading the markets, the biggest problem that we have is we doubt our own selves. Now, I had written a quote, which are my own words, is never go short on yourself. You may short the market, but never go short on yourself. So if you believe something has worked in the last 1 year, 2 year, 3 year time frame based on your backtesting analysis, always have trust in that system. You could have trust in, for example, our research, we have been churning out, accuracy of 70% and above. You could either do that or you could, rely on your own model. I'm not saying, you can pick your own, you can pick your own option, whether you want to do it yourself or you want to do it with our help. But the different approach is pick something which has worked in the past. Now, once you've done that, the second step comes to, which is money management. So if I were to put a number to this, okay, kitna important hai? How important is money management versus how important is identifying the edge versus how important is, having this mindset, which is trading psychology. So I would say the strategy is only 10 to 15% of the game. So out of 100 point, if I give a weightage in terms of importance, the least importance is the strategy or is the edge. To put it simple, whether you follow Rahul Sharma's recommendations or you follow any competition's recommendations or you follow your own recommendations, it is only 10 to 15% of the edge, which is not that big. The second most important is money management, which is like around 30 to 40% of, depending on what strategy you're doing, it is 30 to 40% of the equation. Now, what is money management? To simplify it, say for example, you have ₹1,00,000 to start with and you want to trade, let's say you want to trade on my recommendations. You've heard that, okay, Rahul Sharma gives decent recommendations, let me follow his ideas. So the best way to do it is any edge that you want to play out, any edge that you want to test out, give it 20 opportunities for the edge to work. So what is 20 opportunities? So what happens is there are 22 trading days in a month. So it is approximately a month's time, which is like 20 days or 20 opportunities. And in those 20 days, more often than not, you will have all kind of a market. You will have a booming market. On one fine day, Nifty may be up 200 points, 300 points. You will have a negative market, Nifty may be down 100, 200, 300 points. You will have a flat market, and anything that is not a part of any of these scenarios. You will have like a fair exposure to any kind of a market. Now, how do we divide that into 20 opportunities? So let us say you've started with 1 lakh rupees and you don't mind losing. Say I am okay to risk 50,000 rupees. I for me to make double this money, or I want to grow this money substantially. But today I'm testing the waters. Let me start with 1 lakh rupees. I'm okay to lose those 50,000 rupees. So what you do is you simply divide that 50,000 rupees. So 50,000 divided by 20 will come to 2,500 rupees. So per instance, you have the risk appetite of only losing 2,500 rupees, which means out of 20 risks that you take in the market, or how to take it simply one step further is when you determine your stop loss or your exit, or when you determine the quantity that you will buy a particular stock, you cannot lose more than 2,500 rupees per trade. Now, when you do this for 20 times, 20 iterations, you will have a fair bit of data to see whether the edge is working or not. So in the past it has worked, yes, but in the live market also, whether the edge is working or not working, this will be like a real live market demo for you. Now, what does this? So you may not be on track to reach that 2 lakh target or 5 lakh target or whatever your internal target is eventually year end, wherever you want to reach. But what it will do is it will give you a mental clarity. Okay, out of 20 instances, this guy fails in about 6-7 instances. 1 or 2 ideas are neutral. About 12-13 ideas are profitable. Out of those 12-13 ideas, 4 of them are super profitable. The rest of them are like profitable by 5%. And then you will have more confidence in the edge. What happens with most of the people is beginning of the month, they put that entire 1 lakh rupees in 1 or 2 ideas, and those 1 or 2 ideas may work, may not work, and then they have a better experience with the market. Okay, so some people are telling me that I'm going too fast. Okay, so I'll just break it down, slow it down a bit. So let us take an example of where you can lose 50,000 rupees, where you want to risk 50,000 rupees, not lose, risk 50,000 rupees out of the lakh rupee capital. So what you do is per trade, take a risk of not more than 2,500 rupees. Per trade, not more than risk of 2,500 rupees. And then do it over 20 different opportunities. So once you have those 20 opportunities, you will have enough data to identify that what kind of outcomes are you having. And then everybody is smart in mathematics. You can multiply this, whether you want to do it with 1 lakh or you want to do it with 1 crore. Then we can sort of, amplify in terms of leverage, in terms of, doing more quantity or increasing your capital and have the similar outcome. So this is what is money management is all about. Money management is deciding your quantity. So we have to focus on things which are within our control. So what is in our control? Whether Nifty will go up or down on Monday is not in our control. What is in our control is whether Nifty, when the trade works in our favor or whether it does not work in our favor, what kind of money can we make or we lose? That is basically the trading quantity or the allocation that you are putting in a particular idea. So out of 10 ideas that you do, ideally the best thing, simpler thing to do is divide it equally into 10 opportunities. So out of 1 lakh rupees, 10,000 rupees invest in every idea that you take and then do it. Or if it is on a rolling basis, you could put 20,000 in per trade, 5 ideas open at any point in time and keep on rolling these positions. So position 1 profitable, book off, take the next position. Position 2 neutral, time frame as, say for example, my time frame is 10 days and did not move, we booked it off, move it on to the next trade. Now some of you are asking me, strategy kya honi chahiye? Can you teach us the strategy? So no, we are giving you views, we are giving you the strategies. Trust me, the strategy view hand-holding is always there from JM Financial Research. We will always get these ideas. But today, where we are differentiating, where we are trying to hit or where we are trying to touch upon is how do we, maximize the benefit of the research that you're getting or maximize the benefits of the, existing model that you may have How do we improvise on that? So money management becomes the pillar of your trading outcome. If you go wrong with money management, so this is like a rule. If you do not stick to your rule, if you are not rigid with your rule and say you are flexible, one fine day some friend calls you up and said, okay, please buy this penny stock, this stock can 10x, and you probably put 25-30% of your capital in that single stock, and that stock does not move. That is, eventually we know the story. We've been through that cycle from time and again. So, identifying the edge, money management. Now, obviously goes without saying, when it comes to money management, stop loss is important. You have to follow the stop loss, because stop loss is actually not a negative thing. A lot of people have a mindset that stop loss is negative. Stop loss is like, a shame. Stop loss is not shame. Stop loss is not negative. Stop loss is actually something which is protecting you. I remember 2008 crisis. I know people who bought stocks at 101 rupees, sold it off at single digit like 6 rupees. These were F&O stocks in 2008. I remember a lot of people in 2020, because I was at a different stage, I advised our clients to not book losses in 2020. And today we have, we all see what happened with the markets after the COVID crash. So every 4 years, earlier the cycle was 8 years, every 4 years we will have corrections like COVID. We will have these deep cuts in the market, like 2008 crisis, like 2020 crisis. The next one maybe in 24. The question is whether 24 mein aayega ki 25 mein aayega. We don't have to guess that. But when it comes, do we have a money management strategy to be, taking advantage of that? So I'll give you an example of this. Let us say you have, 50 lakhs to begin with. Say you are coming in today. Today Nifty is at 20,200 odd, and you want to say, let's take 20,000 round figure. So let's say you are starting at 20,000 index, 50 lakh rupees to be invested. Mr. Rahul, what should be my money management strategy? I am a trader, yes, but I'm an investor as well. So when it comes to investing and when it comes to preparing for 2008, 2020 or the next possible Great Depression, how do we benefit from it? How do we plan it ahead? So I would refer to this chapter from The Intelligent Investor, written by Graham Bell. He says that, there is this very simple strategy which you have to apply it over a period of time for it to work. I have seen it happen in 2020, which is why I can vouch for it. So it's called managing your debt to equity ratio. So what is this? Simple words. 50 lakhs, you bring the money today, 50 lakhs, I want to invest in the market. Day one, you park 25 lakhs in FD. And the remaining 25 lakhs, you park it in the market. Say you buy the Nifty ETF. Let's keep it simple. No stocks, nothing. You simply buy the Nifty ETF, and you could even buy stocks as well. I'm just giving for an explanation purpose. Example. Let's say Nifty goes down by 10%. From 20,000 index goes down to 18,000. What do you do here? You simply remove 10% of your money from FD, which is say 2.5 lakhs removed from FD. You put it into equity. Market goes down another 10%. You remove another 10% from FD, put it into equity. So that way you have literally 5 chances of, Nifty can go down by 50% and you could still have some money to be invested at lower levels. So that some money is 10% of your, your FD basket. Now, let us say the market starts reversing. So when the market bounces back, you don't do anything. Once it crosses 20,000, say it goes to 22,000, you move 10% of your money from equity, which has grown by 10%, more than 10% actually, and put it into FDs. Another 10% up move in the Nifty, you remove another 10% from FD and put it into equities. This is how you can actually plan an event like, or be prepared for an event like 2008 or 2020 and still be in a frame of mind where you're not panicking. The media will be howling negative news. TV will be, extremely negative, extremely bearish. Everybody would be bearish. But थोड़ा सा रिवाइंड करके देख लो 2020 में अगर बॉटम जाने दो, अगर आपने 8,000 का लो बनाने के बाद 10,000 पे भी एंट्री किया होता निफ्टी के अंदर, तो आज हम डबल हो चुके हैं. इंडेक्स डबल हुआ है. What happened to stocks was much far more bigger, far more the wealth creation was much bigger. So this is what is money management. So this is not only applies for traders but also applies for investors also. Here you don't have to worry about stock picking. You don't have to worry about and this is like if you do it well for a decade, you will literally, beat the market in a lot of ways. So I would say in the next 10 years, if you want to apply this strategy, we might get another 2020, we might get another 2008, but when it happens, instead of panicking like everybody else does, we have to be prepared with a plan of action which puts us in a simple price derived entry entry or exit, depending on which direction the market has gone. Okay, now coming to the trading psychology part, which is the third most important, which is like 50 to 60% of the equation, depending on what kind of a strategy are you doing. Now, what is trading psychology? So I'll give you an example. Most of the people, they, what happens is, let's say you've gone to DMart, your favorite departmental store, and you see a lot of things are at discount. So you see that today they have a bumper discount, special Saturday discount, or you go to Amazon, there is a sale, you go to Flipkart, there is a billion day sale. We've seen what happens with these sales. These sales go through the roof whenever these periods happen. So in general, we are hardwired to buy something when they are cheaper. But when in markets, the other way works around. So the cheaper stock today might become even cheaper because nobody is interested in buying it, because the demand supply is tilted in the favor of supply, tilted in the favor of sellers, and you might have a losing strategy. But when it comes to a stock which is expensive, we've seen expensive become more expensive, especially in a tough scenario. So today is not a tough scenario, but had the market been tough to trade with, I remember 2018 where large caps may only 10 stocks did well. Small caps were suffering, mid caps were suffering, 40 stocks out of Nifty 50 were suffering. But there were only some 8 to 10 stocks which did very well. So that was a period when it was expensive become expensive. So what we have to do as traders is we have to train our mind to buy something which is becoming more expensive. Now you would say it is not a fair strategy. What if you end up buying at the peak? That is where your stop loss or your money management strategy will come into place, A, and your edge will come into play. Now your edge, you have to predefine, okay, this is what I'm going to do, this is when I'm going to do. Only if it fits my criteria, I will initiate a buy or a sell. Now, let us take a stock which goes from 200 to 250. Most of the people, or forget 200 to 250 is like a very big move. Let's take 200 to 210. The stock has gone from 200 to 210. Like I said in the very beginning, masses will have this mindset to book it off at 202, 203, 204. They will not write profits. The reason why Nifty is going up in September is because retail is short in index futures. I mean, this is one reason we had a 1,000-point rally view in the Nifty. So why does retail get it so wrong? So I'm not saying retail gets it wrong all the time, but retail gets it wrong when it comes to trading. They get it right when it comes to investing, because investing is relatively easier. Trading is something which is the sharpest minds on this planet are fighting, and it's a zero-sum game. I mean, there is no win-win in trading. I mean, somebody has to lose for you to win in derivatives. So what that means is you have to be at the best of your game. You cannot be complacent. You cannot be riding your losses. And if you don't follow your stop loss exit, it is bound to happen what is happening today. So today, FIs have the highest long positions in the last 10-15 days. I think ever since probably 60,000 contracts is what I saw on Friday's data. I'm yet to analyze. And retail is short. So why is retail short? Because retail never sits on profits. They always sit on losses. FI on the other way around is pyramiding on the way up. If you remember Nifty Pathfinder, I had clearly categorically mentioned that pyramid your way up. As Nifty crosses resistances, 19,600 cross, add positions. 19,800 cross, add positions. 20,000, book some profits. But once 20,000 was navigated, add positions. So that is what FI did. They just kept on adding more and more and more and more long positions as the market went higher and higher and higher. रिटेल क्या करता है, डर जाता है, अरे यार मार्केट बहुत बढ़ गया, मैं इसको बुक कर लूं, मैं इसको शॉर्ट कर दूं. Why? So when you say trend is your friend, mean it. Stick to what is happening on the screen rather than what is happening with your expectations. Your opinion is your opinion. It is not the market's opinion. or rather my opinion is my opinion. I may go wrong in my opinion, but at times, even if my opinion is not connecting with what is happening on the screen, you can always question us. You can always question, okay, is this the right trade to take? Should I be betting my money on this? So that is what happens when it comes to trading psychology. Now, one more important lesson that I learned over a period of time, which I want to share with all of you, is there are two types of games. One is an infinite game, one is a finite game where the rules are set, the time frame is set, and there is a definite outcome to it. So all the games that we play, whether it is cricket, whether it is football, whether it is chess, whether it is any sport that you take, any game that you take, all the games that we play are finite games. A finite game, what happens is there is a loser and there is a winner. There is a time frame. Like for example, test match, you have 5 days to play. 2020 cricket, you have 20 overs to play. At the end of it, unless it's a rain affected match, obviously, there is a definite loser and then there is a definite winner. So finite games are fine, but there are some games which are infinite in nature, which is where the different thought process or different psychology is involved. What is an infinite game? Infinite game is where there are no rules. In finite games, we have rules. LBW is out. In football, you have rules of making a goal. You can be shown a red card if you don't follow the rules, and so on. But in infinite games, there are no rules whatsoever. Means it's like jungle. It's like you can literally, the one who is more powerful will decide what will happen with the next course of events. And then there is no time frame. In infinite games, it is, as the name suggests, it is infinite in nature. And lastly, there is no definite winner or loser. In fact, a winner is somebody who stands till the very end. Let me give an example. Politics, Cold War, trading, and investing. These are 4 examples of infinite games where there are no rules, there is no definite time limit, there is no winner or loser. You could say that in trading there is a winner and a loser, but in the broad scheme of things, the one who stands till the very end. Now let us take an example. 2020, a lot of people got in the crash in 2008, in 2020, a lot of people got wiped off. So in an infinite game, they were finite players. So don't be a finite player in the market. How do you become an infinite player? Now this is an important question to address. You understood the point, what is an finite game and an infinite game, but how do we become an infinite player? You become an infinite player when you stop taking risks which can wipe off your capital. The day you start doing that, you make your trading strategy or your portfolio weatherproof. Whether it is 2008, whether it is 2020, or if it is a mini correction, you will not lose your capital. You do that by applying the debt to equity ratio concept, where I explained that you put 50% of your money in debt, 50% of your money in equities, and sort of juggle between the two. You become an infinite player. You become an infinite player when you stop putting all your eggs in one basket. It can happen that instead of doing 10 different ideas, you do one big idea. Okay, this is where we are very highly convinced. Let me put all my money in one trade. That is where you might become a finite player in an infinite game, and you may go back 3 years, 4 years, 5 years in the game, or you may completely stop trading forever. So make small profits, that is fine, but be profitable. Last lesson that I learned on this, which I'm going to share it with each one of you, is there's something called as micro habits. So what are micro habits? Micro habits, or 80% of the things that we do are repetitive in nature. We just keep on doing them based on our hardwiring. So for example, the way we brush our teeth, the way we for example eat, the way we talk to somebody, more or less it is like our moods. It is hardwired into our subconscious. These are habits that we've developed over a period of time. And as from evolution perspective, this was important because you saved a lot of mental energy by not deciding, okay, how am I going to brush my teeth today? Try doing it with the left hand. It will, or for example, if you're righty, try doing it with the left hand or the other hand. It will be very difficult to do. So what happens with habits is, if you develop the wrong habits in trading, you will keep on repeating the same mistakes. How many of you have had the cycle, you make money, you lose money, you make money, you lose money? Yes, sir, I enjoy playing in the markets, I enjoy trading in the markets, but net I'm not making money. a lot of people, I can see a few hands go up, a lot of people have that cycle: make money, lose money, make money, lose money, make money. I mean, eventually what happens is, somewhere or the other you will quit the market, somewhere or the other you will increase the risk. You're just one wrong mess up away, one mistake away from getting your capital wiped off or having a very, very unpleasant experience in the market. So the point I'm trying to make is, make yourself an infinite player, develop habits which are beneficial for you. So when I was explaining the concept of micro habits, or when I learned this concept of micro habits, start with small things first. So I'll give you my own example. I used to hate working out. I used to hate exercising. But then I read this book called Micro Habits or Mini Habits. I think that is the name. I read it in the COVID lockdown. What that book shared was, if you don't like exercising, do one simple thing. Do just one squat per day, one push-up per day. Do it for the next 6 months and see what happens. So what happens is, when I did just one squat per day, I felt good about myself. My target was one exercise per day. I did it. I'm happy. Instead of saying I'm going to go and belt the gym for 1 hour, and when I don't do it, if I miss the gym, I feel negative about myself. I say, you're good for nothing. You're not going to reach anywhere in the market also. You're not going to reach anywhere in your health also. So please stop. I mean, what happens is, when we set big targets, when we don't attain them, we go negative about ourselves. So apply that to the market. Instead of saying I'll make 1 lakh rupees this month, you say I'll just make 1,000 rupees per day. If it comes, I'll be happy. Even if it doesn't come, it is fine. But 1,000 rupees possible to make in a day. That is what my goal should be. Mini habits. Or if somebody feels that 1,000 rupees also big, have a target of making 500 rupees per day. We can all do that. Always, obviously, those who are bigger in the group, those who are participants are trading with a bigger capital, the money can be multiplied. I mean, it can be bigger in terms of targets. Can be, instead of 1,000 rupees, you can have a 10,000 target or a 1 lakh target or a 10 lakh target, depending on how big you are. But I'll give you an example. So when you set these mini habits in place, and when you do it well over the period of time, say you had a target of 1,000 rupees a day, you kept on hitting it consistently. Some days you might make 5,000, some days you might make 10,000, some days you might make even more than that. You will be very happy about yourself. The target 1,000 was there, I made much more than that. So it's like a very big victory. So mentally what happens is, you rewire your brain in doing the right things. You stick to your rules. You're making money, there is evidence in front of you that this is working, and then all you have to do is change orbits. So after you've done for 6 months, that is what I did. I did for 12 months. Obviously, I was not consistent, but still it was better than, going to the gym. Many times, January will come, a lot of people will say New Year resolution, let me join the gym. A lot of people join the gym in January only to leave it in February. Or most of the people even stop, leave before that. People just go and don't show up at the gym. Why? Because they have not developed the habits for it. When it comes to trading, we have to develop the right habits. Only these right habits will make you an infinite player, will make your portfolio and make your strategy weatherproof. And once you have done it for 6 months, 12 months, change your orbits. Then you say, okay, now I'm going to take it to the next level. Increase leverage, increase your position sizing. Now that, because you have an increased conviction on these ideas, this edge that you are playing on, you will be in a different ball game altogether. Fast forward this next 3 years, 5 years, 10 years, you possibly might be the next Rakesh Jhunjhunwala. You might be the next blue flagship trader that JM Financial has. So this is where today's webinar was about. Something which is very important is what goes on between your head. If you can do that well, if you can do it consistently, and even if you can apply, say, 25% of what we've learned today, I'm very sure your outcomes of your trading strategy will be vastly different in the time to come. I had promised to keep this as crisp as possible, as short as possible, because this is a concept where I can talk for the entire day's length and still it will not be enough. But what I've discussed is the key crucial points which can play a very big role. Okay, one last thing which has helped me personally a lot is journaling. So when it comes to trading psychology, always make it a point to write it on your diary, on your daily diary. This is what went right today. This is what went wrong today, and how the wrong could have been better. I learned this from the world's biggest hedge fund manager, Ray Dalio, does that. He's retired now, but he has like 30 years of journals or notes that he's made for himself. And whenever he has a problem, he just revisits those diaries. Okay, 20 years back, what did I think when I made a particular decision? And he has it in his own handwriting, in pen and paper, and he refers that. Now just imagine that when you have 3 years, 5 years of data that you have yourself written, you are literally at a level playing, if not a level playing field, a better playing field as compared to AI and AGI, which is eventually going to come into the markets in the due course of time. So the only way to do it is either improve your own game or hire an AI which can do that hard working for you. So as of now, we don't have that AI which can be hired to do this data heavy lifting for us. But eventually it will come. First it will come into trading decisions, which is where the large prop desks, the large institutions, FIs will apply this technology. And then eventually it will seep down to the common man, or not the common man, but the bigger traders as well. So my idea is, can we stand a chance against this big brain that is going to take money away from us? That this is one way where we can increase our chances, increase our odds of doing it. Thank you so much, and have a very good weekend ahead. Stay profitable, stay bullish. That is the mantra.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.